We're going to touch on monetary policy, so I'm going to have you just pause on the AD model. We're going to talk a little bit about monetary policy today. And, what's the purpose of doing a classroom experiment? Well, one, you all don't know me. So, you've established some trust with Professor Costin over this semester. He's told you some things. You looked in your textbook. It seems like there's a good empirical basis that's true. But since I'm new, you all don't know what I can tell you, if it's true or not. So that's why we're going to run a classroom experiment, to make sure that the empirical claims that I make are true within the spaces of the classroom, and then, of course, application to the world. So to get started, you will need a technological device, whether that is a smartphone or a computer. And what you're going to want to do is go to www.moblab.com, or if you're on your phone, just search Moblab and download the app. And if you don't have a device on you, you can pair up with someone in the classroom that does. And you'll just be a corporation of two, so you'll be making business decisions together. I have the code up here as we go along, so just feel free to raise a hand if you need that class code, you can't see it, or if you're having technological issues, my colleagues will help you out. So what does the money multiplier tell us? So for each dollar the Fed increases reserves is by how many deposits we keep in the bank. So the money's supply can increase and the Fed can control that. So if the reserve ratio is 20%, then the money multiplier is 5. So that means the Fed controls the ability to multiply money in terms of money that banks can lend out. So in the real world, how does the money multiplier work? Well, it's not always as large as the Fed anticipates. Why? Because you may keep money on hand. There's some people that believe that they should keep money stashed in couches or mattresses. The money multiplier isn't as large because banks can't keep, they have to keep their reserve access above zero. There has to be at least some money in the bank. That way, when you all came to me and wanted some money out, there'd have to be some money on hand. So if either of that happens, that's why the impact of the money multiplier is sometimes smaller than the Fed anticipates. So there's 3 different monetary policy rules, and I'm just going to lightly dust on these so that you'll go in depth with these later on in the semester. So first is the required reserve ratio. So that's how much money the bank has to have on hand, and that's really with that multiplying effect in terms of if I have to have so much cash on hand, that means the more I can lend out and charge interest or fees. There's also the discount rate. So the Fed controls all the money, and that means the discount rate is just how much I would take as a bank, I would take from the Fed in terms of loaning out money to then make other loans. And the Fed generally frowns on too many visits to the discount window, so it's sometimes not used as much in terms of monetary policy. And then there's open market operations, which means buying and selling bonds and other government securities. So today we're going to play a simulation called Bank Run. And the basis of the game is we're an island bank, and we take deposits and make profitable loans. That's how we make money. And you all are going to be depositors into this island bank. You'll be placed in groups of 6, and each day will be in a market for 5 days. You'll be choosing whether to just withdraw your deposit. So there is a catch to this bank. If the bank fails, if too many people withdraw, I wouldn't have enough money on hand. So how does this affect the game payoffs? Well, if the bank doesn't fail, you all receive your deposits plus interest. And if you withdraw and the bank has not failed, then you get back some of your deposit. If the bank fails, well, I'm sorry, there's just no other money I can really offer you. You're going to withdraw and lose your deposit. So how will this look on your game screen? So this is the island bank, and we can see there's 6 investors, so 6 people within the room, dispersed randomly, will be in one market, and you all invest $100 into this island bank. In this game, instead of days of maturity will be 5. So it'll take 5 days to receive your interest of $150. So the bank will not fail if only 3 people withdraw. If more than 3 people withdraw, then the bank will fail and become insolvent. So this last line, you can see you will receive $150, and it'll be on day 5 in this case. So how you can monitor your market, you can see how many people withdrew each round and each day. And your decisions are either to leave your money in the bank or withdraw. So with that, I'm going to go ahead and finish the survey. And we're going to do the first bank run game. So if you're not seeing a game on your device, raise your hand. We'll help you out the class code or pair up with someone with this device. So for those who withdrew first round, why did you decide to withdraw the first round? How come you decided to withdraw the first round? So there's a sense of security. How come you withdrew your money the first round?
I don't trust others.
You don't trust your classmates. You figured other people might probably try and take your money. Anyone else why they decided to withdraw? So what we just articulated here is a best response scenario. If you feel that other people are going to withdraw, you should withdraw your money, guaranteeing that you'll at least come out with some money. However, what if there's a scenario where we could all trust one another in this room? So this next scenario, we're going to play with deposit insurance. So to give you an idea of what that will look like, there's still a maximum safe withdrawals. You can still receive $150, but you at least have this deposit insurance of $100. So you're at least guaranteed that you'll receive your initial deposit back without interest. So with deposit insurance on the table, we're going to go ahead and play this game one more time.